watching another video of insightful principles. In today's content, I want to talk about is stagflation on the horizon? Are we in a recession? What will the Fed do in their next meeting coming up on July 28th? All of these questions will be answered throughout this video. I'm also going to break down some economic indicators that I'm paying attention to that will be coming out in the near future. But if you all could do me a huge favor, please like, subscribe, and share this video. Continue to hit that notification bell below so you can be notified each week when I drop content. So the June CPI numbers came out today, July 13, 2022, and the numbers came out at 9.1%. This is not only the highest that we have seen in 41 years, but it's the highest we've seen so far this year. Inflation so far throughout the year has been ranging from somewhere around 7.5% and now 9.1%. Rather, also, the most recent CPI numbers that we had for May was only 8.6%. So it just goes to show that it has been a constant increase, and some of the main areas that increased the highest was food at home, shelter, and also energy. We think about inflation so far this year. The reason why I'm saying stagflation is because we've pretty much been hovering around 8% to 9%. In March, it actually was at 8.5%, as you can see here from this chart. In April, it was at 8.3%, and then in May, we've seen 8.6%. And then now, of course, we're at that 9.1. So it definitely has been ranging, and it is showing that we could potentially be in a stagflation environment, because that's exactly what it is. Inflation is high and is pretty much staying within a range, and it's not really moving. It's not really significantly going down, but it's pretty much just staying where it's at. So I definitely think when I say stagflation, that's what I mean. And also, the growth in the economy starts to slow down as well, which we are seeing that for the first quarter of the real GDP, which is the gross domestic product, which measures the economic activity within the economy. We had a negative quarter, and we're now waiting for the second quarter estimates, which will be coming July 28th, which is the same day for the Fed meeting that's coming out. So that day is going to be jam-packed. So if you don't have any other day marked on your calendar, July 28th is definitely the day you need to be paying attention to. But food at home was up 12.2% year over year. Gasoline 59.9%. Fuel oil, when you think about jets, you think about airplanes, 98.5% year over year for fuel oil. Electricity was 13.7%. Shelter was 5.6%. So within food, the CPI highlighted that butter and margarine actually increased 26.3% year over year. Fruits and vegetables also rose 8.1%. And then lastly, cereal and bakery products rose 13.8%. Now, there was some declines that they had within CPI. They mentioned that meats, poultry, fish, and eggs, that did go down a little bit for this month compared to May. And then airline fares have gone down as well. Now, I know the gasoline was one of the biggest increases throughout the whole report. Between food and gas, those were the two things that significantly impacted the CPI to bring it at 9.1%. Gasoline index was at its largest 12-month increase since March of 1980. And gas has come down a lot since May. So even though the June reports are showing a high number, you have to keep in mind inflation is a backward-looking indicator. It's a lagging indicator, which what that means is we're already in July and we're seeing the reports for June. So I know for myself, we can see that gas prices are not as high as it was last month. So I definitely think that when it comes to the CPI, you have to also keep that in mind that it is a lagging indicator. This data has already been facilitated throughout the economy, and we're now already in a different economic condition when we think about what we're paying at the grocery store and what we're paying for gas. It's still fairly high, but I can see why these reports came out, why the CPI report came out high, because last month was pretty brutal. When you think about $5 gasoline, almost $6 in certain places. You also have food prices that were up. My grocery bills, I was seeing, $50 increases than what I'm usually paying. But this month it has came down a little bit, but I still think that we're still going to see rapid increases throughout the year. I don't think inflation is going to be going down anytime sooner. And I definitely think that the Fed is going to have to take an aggressive take on their next Fed meeting. In fact, there has been a lot of talks of them actually doing 100 basis points. And right now, the federal funds rate is 1.50 to 1.75%. And all of that means is that's the rate that banks charge each other whenever they're sending loans or reserves back and forth to each other. This is the rate that is attached to the loan. So the federal funds rate potentially could be impacted with going up even higher with a 100 basis point rate hike. All that means is 1%. It will be a 1% increase. So I definitely think that market expectations are saying that they are going to have to be, the Fed is going to have to be more aggressive for the July 28th meeting. And people are also saying that for September, it's looking at more of a 75 basis point rate hike. So I definitely think that, a mix between all those different things, you are seeing a lot of recession talks because we're having issues with, economic growth going down. We're seeing inflation causing rapid increases amongst food, shelter, energy. And we're seeing that the Fed is now going to have to take an aggressive take of increasing interest rates even more, which is going to bring demand down, which is going to bring consumer spending down. And all of that has an impact on economic activity, which can lead to a recession. But honestly, the economy needs a recession. It washes out the bad companies, and it really shows that the good companies that are able to weather the storms, that have strong balance sheets, that have good earnings, that have good cash flow, they're going to be able to persist through the economic uncertainty. But the companies that are not effective asset allocators, or they're not effective entrepreneurs, or business owners, they're going to have a hard time in this type of climate. So I definitely think that for the July 28th meeting, with the Fed coming out with whether it's going to be 175 basis point rate hike, I definitely think that it's going to potentially be 100 basis points. And then also with the real GDP numbers for the second quarter of 2022 coming out, that is going to be a very important day to see if we're technically in a recession, because a recession is technically 2 negative consecutive quarters of GDP. Also, we have the producer price index. That's coming out tomorrow, July 14th at 8:30 a.m. Eastern Standard Time. And I did want to break down some of these global inflation rates that we're seeing across the world. The macroeconomic environment is definitely something that I'm paying a lot attention to, because I do think before a recession happens here in the U.S., it's going to happen somewhere internationally first. And a lot of talks have actually been with Europe actually going to be the one that's going to go into a recession before us, because they are dealing with a significant energy crisis. They're having, some supply chain issues when it comes to an energy standpoint. Also, the euro fell below the dollar since the first time since I believe it was 2002, and it's also at parity with the U.S. dollar as well. So I definitely think the euro, with their currency, they're seeing a lot of devaluing with the currency, and it's actually lower than the dollar. The dollar is strengthening, but as the dollar strengthens, that also impacts other countries when it comes to a trading perspective, because if you are someone that's in Europe and you have a euro dollar and you're trying to find a way to make sure that your euro is going above the US dollar, and let's say you're a person that's working within the monetary supply system, not just an average person, they want to short the dollar. They don't want the dollar to be better than their currency. So I think from a trading perspective, from when you think about imports, which imports are goods and services that come into a country. Exports are goods and services that go outside of a country. When you have the US dollar strengthening and you have the euro going down in Europe, they are going to want to have less imports coming in with the US dollar, because that is their currency is devaluing against that. So they're going to want to export more of their euro dollar because they want to try to lift up their currency. So I think that that is going to be something to pay attention to. As you can also see here, some other eye-opening global inflation rates that I see is with the UK, they're at 9.1%. In Italy, they're sitting at 8%. I talked about Europe, they're at 8.6%. Brazil is at 11.89%. Russia 15.9%. You get the point. As you can see here, inflation has impacted everywhere, and it's impacting a lot of different countries on a global macroeconomic scale. And I definitely think that keeping a pulse on what's happening internationally is going to have a significant impact or a contagion effect when it comes to what happens here in the US. I definitely think as an investor, you have to continue to observe, do your research, read these different reports. I'll put all of this in my show notes, but you want to understand what's going on in the US, what's happening on a global scale, so you can be able to prepare your portfolios so you can have an investment thesis on how to diversify in any type of economic condition. So I thank you all so much for watching this video. As always, continue to like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. And thank you all for listening and watching, and take care.